Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, July 26th, and then we'll see how things look for Thursday, July 27th. As expected, the Fed came in and raised interest rates 25 basis points, or 0.25%. Not really a surprise there. What the market was really waiting for was, what was Jerome Powell going to say at the press conference? At first, it looked like, wow, the market's going to take off and go higher. Well, then he said some other things, and the market ended up going lower. By the time we were finished, we pretty much finished right about where we started. We were down slightly. We're still in an overbought situation. The market is still looking positive. There's still a few little signs of weakness, but we're also seeing a little bit of strength coming into the market that I'll go through. Let's go back and talk about what happened. At the open, we had a lower open. Prices found support at S1, which was at 45.53. As the day went on, this is pre-Fed announcement phase when this happens. Prices rose and then declined above S1 before the Fed announcement, so everything kind of calmed down a bit. After the announcement, there was not much initial reaction until the press conference started. The market gyrated a little bit, but not very much. As the press conference was unfolding, prices climbed to R1 at 45.81, then fell back all the way to S1 before closing almost unchanged. So we were down 0.02%, pretty much unchanged on the day. Volume was still below average. Typically on a Fed day, you might see a lot more action, but we're in the summer months. A lot of folks are gone. The market's overbought. Things are still positive. People are holding on to things. So we're not necessarily seeing a lot of above average volume. The technicals are still positive, but overbought. We haven't really changed in that regard. Inflation and interest rates are still the real focus of the market. What are some comments that we can make? I called it a treadmill day, where we ran and ran and ran, but then ended up finishing right where we started. The Fed did raise interest rates 25 basis points as expected. One of the things to kind of sum up what Chairman Powell said was that inflation has moderated somewhat. Well, we can all kind of see that. Since the middle of last year, that was June of 2022 when we topped out, but that getting back to 2% has a long way to go, and he's thinking maybe out into 2025. The market didn't like that very much, and so the Fed will continue to make its decisions meeting by meeting. It's like they do that already anyway. This is just talk for they're not really sure what's going to happen. They don't want to spook the markets too much, but at the same time, they want to let the markets know that they're trying to fight inflation. Earnings reports that came out were taken mostly as positive. Microsoft came out, Google, Boeing, Coke, and AT&T all reported. Small caps and banks had a good day. We're still asking this question about this positive scenario. We don't know if this is really going to shift now. The market has some new information. Are they still going to develop this idea that we will have a soft landing, that the Fed is almost done, and that earnings looking forward still look positive? On a short-term basis, we still have kind of a long list. We have our moving average study, the Williams percent R, the standard deviations chart, the stochastics, and the RSI based on 9 periods. Intermediate term, also a longer list. The rate of change going back 50 periods, the PMO studies, the oscillators, which are really turning more negative now rather than showing a negative divergence, but we're still keeping an eye on that. The Sean Trend Meter, the bullish percent index, both for the S&P as well as the NASDAQ 100, and the RSI based on 14 periods. Long term, the 150 and 200-day moving averages are still looking a little extreme. The dollar was down and interest rates were also down. Now, both of these should have given some support to stocks, but Fed days are like their own day. It's kind of like options expiration. You can't really apply what's been happening as far as logic to these other days when critical things end up happening. We still have all of the yield curves that we follow that remain inverted. Sentiment is still extreme. We ticked down to 80 where we had been at 81, but we're still showing a lot of exuberance. Our trend is positive, but now the green line's coming down a little bit. The ADX is above its moving average, and both of them are above 20. They're also close to 40, suggesting either good momentum or that we're getting overbought. I'm keeping our bias at positive since it was pretty much an unchanged day, and our momentum continues to be positive. What are the economic reports that came out? We had the weekly MBA mortgage applications index. In total, it was down 1.8%. Purchase applications were down 3%, where refinance applications were unchanged. New home sales came in down 2.5% on a month-over-month basis. When you project that out annually, that's 697,000 units, less than the 722,000 units that they had expected. Last time the reading was 715,000 units. On a year-over-year basis, that means an increase of 23.8%. Here are some charts showing the applications. Where we did decline, we're a little bit below zero. New home sales did tick down in the latest reading where it had been showing some recovery. And when you look at the 3-month average of the prices, it does continue to decline. We're coming back down to this previous level. We'll see if it continues to fall from there or if it turns and goes back up. Some IsabelNet.com blog charts. The first one, this is from Real Investment Advice. This kind of goes hand in hand with things that we've been talking about already. It's taking the S&P 500 and the sentiment gauge and putting them on top of each other, suggesting that we're getting kind of overextended to the upside, which is what we're seeing in our other charts. And then they mark out different things that have happened along the way. We're also showing discretionary versus systemic equity positioning. Discretionary is when you can pick and choose. You can time when you want to get in, when you want to get out. That's actually doing a little bit better versus the systematic approach where you just have a set of rules that you follow and you don't deviate from that. So the discretionary is actually showing more improvement where it had been lagging behind. Looking at the equity bond ratio, this predicts a recovery. The blue line is starting to go back up, where the ISM manufacturing is still going down overall, but maybe it's starting to bottom and possibly can start to come back up. We'll get those reports later on. When you look at risky versus safe asset fund flows, it's still showing that folks are more risk averse. They don't really trust what's going on, which is part of the strength behind the market. It likes to climb a wall of worry. It likes to go up when everybody thinks it's going to go down, and it likes to go down when everybody thinks it's going to go up. And so you have folks taking kind of a bit of a contrary move to what we're seeing in the charts. Then we have the S&P futures positioning, showing that this is really going up as the S&P has been going up. A little bit of a decrease in the futures positions as the S&P continues to go up, and we're hitting this overbought condition, which seems to be going on and on and on. Also, looking at the core CPI inflation, it was down in June, and what we think will prove to be a turning point. Looking in the middle of this chart, this is where we're at right about now. This is the last report for the July meeting. They think that inflation is going to continue to decrease, and that will help the economic growth overall. Then we're looking at the Russell 2000. These are the small cap futures positioning. This is starting to gain some favor now, so you're seeing more folks getting into futures contracts as the Russell 2000 has been showing some improvement. And then just to compare this, I already showed this chart. The NASDAQ 100 also is seeing an increase in futures positions as the NASDAQ 100 has been climbing. Looking at the Fed funds target rate, Goldman Sachs is predicting that it will fall down to 4.6%. The futures market is also confirming that. And then looking at the equity allocation, it's still at about 61%. We're above average, so folks are getting more into stocks. Then 11-day winning streaks. We're actually on a 13-day winning streak for the Dow now, but this chart is a couple of days old. What are the returns going forward in the 1-month, 3-month, 6-month, and 12-month return? Looking at our charts and analysis, here's the intraday chart. We had a lower open, and then we came down to S1. We bounced up a little bit, came back down to S1. Then, this is when the announcement was made. That didn't produce too much of a gyration, but then we shot up all the way to R1, then immediately did an about face and came all the way back down to S1, and then saw some buying going into the close. By the time we were finished, we were pretty much done changed. Here's the intraday chart showing all the gyrations, and we're drifting just a little bit higher in the initial overnight session. Value outperformed growth. They both were down on the day overall, but in some of our other charts, we're seeing a little bit of improvement with growth. On a closing basis, growth was down with the large caps compared to value. It also underperformed with the mid caps as well as the small caps. Looking at the intraday chart, we were positive for a lot of the day, but ended up closing when we look at the S&P growth to value ratio. Sentiment, still showing that there's not a lot of fear. The Ulster Index continues to fall. The VIX also continues to fall with the line chart as well as the bar chart. And volatility, which you might think may have picked up after the Fed meeting, no, it's actually decreasing the volatility of the VIX. We're also keeping an eye on the VIX to S&P 500 correlation after spiking up and coming down. In the context of what we're looking at, since we're so overbought, this typically could mean that we might see some negative things going forward. This has been showing this way for quite a while now, and we're not really seeing much of a downturn in the market. Looking at the 5-period simple moving average of the equity put-call ratio, we're wondering if we're bottomed now and are starting to go back up. This would be more negative for stocks, since this ratio tends to go down as the market's going up. Looking at a longer-term version of this chart, we're down below the 0.55 level and just kind of bouncing around as the market figures out what it wants to do. But longer term, we're still looking more positive. The equity put-call ratio is continuing to decline. Looking at the MOVE index, we ticked up a little bit with bonds since they were down on the day. We ended up dropping with the VIX, which measures volatility in stocks, and we're showing the correlation starting to go in opposite directions right now, where they typically go in the same overall direction. The fear gauge that we look at on this chart shows that fear continues to decrease. This other fear gauge is also showing a decrease. We took a little bit more of a hit with the risk on, risk off ratio, but we're still tending to go up overall, meaning folks are favoring stocks over bonds. Our advanced decline line showing some real good strength here based on price, and that advanced, we actually turned up a little bit based on volume. So that's looking more healthy. The one little bit of concern, as you can see, as we're going up, the green bars on top are starting to trail off a little bit as we're seeing a decrease in volume. Looking at the new highs, they continue to hold up fairly well. The 5-period is rolling over a bit, but is still above the moving average. The 10-period has actually started to go down, but this is still looking fairly healthy overall. The advanced decline ratio ticked down a little bit, but is still above 0. That's positive. Accumulation distribution is coming right back up to the moving average. That could be positive. Since we saw some weakness here, is the smart money starting to come back into the market? We saw an improvement on the cumulative advanced decline line for the NYSE. And then on the bottom, we're also seeing some improvement with the regular NYSE advanced decline line. Looking at our other advanced decline line for the NYSE, we're starting to break out above these previous highs. That's showing improvement. When we look at common stocks, seeing some improvement based on price. We're coming back up to this previous high. We're seeing a little bit of a negative divergence still based on volume, but it is showing some improvement. Looking at our advanced decline line studies, we were up with the NYSE, the S&P, the mid caps, and the small caps. Looking at our trend, here's the ADX, which is the black line, getting close to that 40 level. There's nothing magical about 40. It's just a lot of times when we get this high, it means that the market is overextended to the upside. But if we stay here for a while, that can also suggest good momentum. It shows that the trend is strengthening because we're above the moving average. However, the green line's on top, so we default to positive, but it is now declining. Looking at our shorter term ADX chart, we're also above the moving average. We're above 40, and the green line is also declining. Volume continues to drop off and is still below average. Our short-term charts, where we're not quite back up to the underside of this trend line yet, we're still above this pivot level. So far, this support for the S&P is holding. And then on the bottom, you can see where we drop to below average. We're still hanging in there with our 20-period double and triple exponential moving averages. We're down underneath these, but still we're not getting very far away from them. The 20-period exponential moving average is no longer extreme positive. However, the 50, even though it's rolling over, is still extreme, still showing some improvement with the 200-day exponential moving average. The Williams percent R ticked down a little bit, but is still extreme positive. The stochastics, still extreme in the short term and intermediate term, looking a little more negative in the long term, but we're still extreme positive. The force index was pretty much unchanged and is above 0, so that's positive. Our intermediate term charts, the balance of power, we went back up. We're above the dashed line. That's positive. We're still hanging out around the triple exponential moving average. That so far has been holding up. If we see some weakness, we'll be watching the blue line, which is a double exponential moving average, to see if it provides support. It has done that recently. If there is some weakness, we want to know if this level is going to hold. The go-no-go system remains positive with the darker blue bars. We're kind of flattening out a little bit with our highest high value, but we're still near the top, suggesting that things are positive, but slowing down a bit. In the TTM squeeze, it had been positive, and then it turned to a darker shade of blue, which was suggesting a little bit of negativity. Well, now it's turned back to the other shade of blue, which is more positive. We're still right at the top at the third standard deviation, suggesting that we've gone up pretty far, pretty fast. And the rate of change going back 50 periods is still looking extreme positive. The Erin indicator, we're still seeing a real advantage by the buyers as the sellers are decreasing. So when we compare the two, the oscillator is ticking up and not giving us an extreme reading yet. Looking at the S&P 500 McClellan oscillator, it did decline a little bit, but it's still above zero. When we look at the summation index, we're starting to break out above this previous high based on price. We're still going up based on volume, but we're lagging a little bit, so that's a bit of a negative divergence. When we look at the NYSE McClellan oscillator, it ticked up and is above zero, so showing some improvement. And then when we look at the NYSE summation index based on price, it's showing some improvement, and we're actually starting to break out based on volume. This is one of those charts where volume is actually looking a little bit better now than price, where price is lagging behind. The Swenlin trading oscillator based on price turned down just a little bit as well as with volume, but both of them are still above zero. The PMO trying to roll over a little bit here as the market's slowing down a bit. It's not negative yet. We're still advancing based on price and volume. When we look at the PMO studies, we are decreasing with the percent of PMOs that are rising, also declining with the buy signals, still showing improvement with the percent of PMOs that are above zero. Again, extreme positive, but also could suggest good momentum. The Elder Impulse system for the S&P still remains neutral. The parabolic SAR still remains positive. The slope indicator starting to come down, hasn't quite crossed below its moving average yet. The MACD also showing some weakness, but not below its moving average yet. So when we look at all of our different oscillators, we're starting to kind of change our view on these negative divergences as some of these oscillators are starting to turn negative and flatten out a little bit. We're actually looking a little more positive in the long term now with the TRIX and the KST. The Sean trend meter declined a little bit, but is still extreme positive. Also, extreme positive or showing good momentum is the BPI. It ticked down slightly, but it is giving us a good healthy sign right now. The NYSE bullish percent index continues to advance and showing improvement. The Chaikin money flow ticked up just a little bit, but is still below the moving average. However, it is still positive. The Chaikin oscillator turned back up after dropping below zero and turning negative. It's still negative, but showing some improvement. The money flow index ticked down just slightly, but is still above zero. That's positive. Ultimate oscillator ticked down also, but is still above 50. The RSI, we're still noticing this longer-term negative divergence, which is becoming more and more irrelevant as each day goes on, and because we're starting to get extreme positive with the 14 period and the 9 period. The vortex with the green line has turned back up. That is positive. On balance volume ticked down slightly, but continues to be positive. We're seeing a little bit of improvement with our 200-day moving average study of the S&P 500. We're starting to break out above this previous high. With the 50-period moving average, we came right up to this level, and we're starting to show a little bit more weakness. So longer term, we're holding up okay. We might be seeing some weakness in the shorter term. And here's a look at that same chart just plotted with a histogram. The Copic curve continues to generate a buy signal, as does the Pring bottom fissure. Our Fibonacci and line studies, only one chart to show you. We're coming up to August 1st. We have been really advancing during this last 50-day cycle. When we get around that August 1st date, is that going to produce a change in the market? If you go back and look at other times, sometimes that marked a bottom, sometimes it marked a top, sometimes it was irrelevant. Our different charts, the Heiken Ashi still looking positive. The Kegi is still pointing up and looking positive. The Renko continues to be positive, and the 3-line break is also positive. Our different indexes showing some improvement now with the equal weight index. It's starting to come up and perform about the same as the S&P 500. We saw a little change in our overall ratio. This real spike up was when the bigger stocks were leading the market higher. If we see this ratio coming down and the market's still going up, that means there's more broader participation. Looking at Dow theory, still setting new 52-week highs with the Dow. That's looking strong. Saw a really good day for the transport. So that was an improvement that will really help the market. We're also coming back up to this trend line with the utilities, and that could be putting a little bit of pressure on the S&P. The transports to S&P 500 ratio did see a nice advance, so that's what we want to see in a good, solid environment. When we do a correlation between the two, we're seeing a little bit of an improvement between the relationship of the S&P 500 and the transports. And we're seeing now that the transports may be starting to actually outperform the Dow. That could be pretty healthy for the overall economy. Keeping an eye on our discretionary to staples ratio, we were up slightly with discretionary. We were also up with staples. Our ratio overall ticked back up, but discretionary continues to outperform staples. The Dow just continues to look stronger. It's not showing momentous changes on a percentage basis, but it just continues to chop higher and higher and higher pretty much each day. The diamonds have, though, switched back to neutral. The NASDAQ, after coming up to this R1 level, falling back down, it was down a little bit in Wednesday's session, and we're dealing with this pivot level right now. We're keeping an eye on the 61.8% retracement level. If we start to fall, will that act as support? Also, seeing continued weakness overall with the cumulative new highs and new lows for the NASDAQ. The indicator down below is slightly positive. We're seeing a little bit of a turn up here, but we want to see this turn and have a sustained upward movement to show improvement in this chart. We're also watching the NASDAQ 100. After hitting overhead resistance at R1, coming back down, it was down again on Wednesday's session. We're just a little bit below this pivot level. The Qs, though, remain neutral for the Elders Impulse system. Also watching the NASDAQ 100, where we were making higher highs based on price. We made a lower high based on the PPO, the momentum oscillator, and we're continuing to be negative with the PPO. That's another warning sign. The bullish percent index for the NASDAQ 100 continues to decline. Once it goes below this line, that's an official overbought signal. If we keep falling, that could bring some real negativity into the market. And if the NASDAQ 100 turns more weak, that could also feed into the S&P 500 since there's a lot of stocks that are in both indexes. The small cap index based on the S&P was up and showing a little bit of improvement after giving us a recent golden cross. We still remain neutral for the Elder Impulse system for the small caps. We're still below this resistance level with the small caps. If we could break above that, that would be much more positive. Also working off of a recent golden cross. The MACD is positive but showing some weakness, and we're going back up to an extreme positive reading with the RSI. Looking at the small caps to S&P 500 ratio, it ticked up just a little bit but continued to underperform overall. Comparing small cap growth to value, we did decline. We're still in an uptrend, but we've been doing a lot of chopping sideways. The mid caps continue to hang in there. They're holding above this pivot level support. They were up 0.5% on Wednesday. We're working off of a recent golden cross. With the Elders Impulse system, though, we still remain neutral. When we compare mid-cap growth to value, overall, it's still in an uptrend, even though it declined slightly on Wednesday. The dollar saw a little bit of a decline, but still is above 100. And we're still below the all-time high for the FANG index. It was down in Wednesday's session. We're wondering if we can get up enough strength to come back up and retest this previous all-time high. When you look at stocks and compare them with further out bonds, the market still is suggesting that we will see a soft landing. The banks had a pretty good day. The bank ETF was up 3.72% and is showing some good solid strength as of late, but is still in an overall downtrend. The financial sector was also up, but not quite ready yet to generate a golden cross. When we compare the financials to the S&P, seeing some improvement, but still in a downtrend. And when we look at the regional banking ETF, it was up strong, but still in an overall downtrend compared to the financial sector. Keeping an eye on bonds, we were down based on yield and up based on price. We've been able to regain the 200-day moving average. The RSI is right at about 50. The MACD continues to be positive. This is a chart that I showed the inverse of just a few charts ago. This compares bonds with the S&P 500. On the other chart, we're seeing the S&P 500 really going up. Well, this is showing how bonds are really going down and underperforming stocks. We also are keeping an eye on the value to growth ratio. The correlation's starting to show that they're going in opposite directions. Typically, what we'll see is these will go in the same direction when compared to the 10-year yield. Folks are still favoring risky bonds over more conservative bonds. We saw a little bit of a tick up in this ratio. We're seeing some improvement longer term when we compare the S&P 500 to the long-term bond ETF. We're finally coming back above this dashed line. However, in the short term, we're still seeing a weakness of this overall relationship. What we typically see is both of them going in the same general direction, and that's not happening right now. The spread between the two is still very wide, where it tends to not get that far apart. We're also keeping an eye on this. In a good solid environment where we knew a lot more about interest rates and had more certainty, this ratio would be going down. It's since been going up, even though it ticked down slightly on Wednesday. Looking at the Qs and the longer-term bond ETF, they're having more of a tendency to go in the same direction. Our long-term charts, we're still looking good with the special K on the daily chart. The weekly chart is still negative but showing some improvement. We're looking a little overextended with our 150 and 200-day moving averages. And we're still dealing with this resistance level on the S&P 500 weekly chart. We're still above this point. If we see some weakness coming into the market, are we going to fall below this? Are we going to maintain price right at about this level? Or are we going to be able to eventually break above this resistance level? We're seeing pretty much that same thing with the NASDAQ 100. We're still above this resistance level. We're wondering, are we going to be able to break above that? Will we go below it? Or are we going to stay camped out along it like we have been lately? Then looking at the NASDAQ 100 to Dow ratio, we're still giving a very high reading. Other times when we got about up to this level, some really bad things happen in the market after that. An update of our possible positive scenarios. This is also kind of negative. The Qs are starting to underperform the S&P. Discretionary is also underperforming the S&P, and large cap growth is underperforming large cap value. With our other growth to value ratios, the large caps, mid caps, and small caps are all underneath their moving averages. The S&P to utilities ratio has been coming down the last couple of days. In a good, solid, positive environment, we want to see this ratio going up. When we look at the broad range of the 5-period simple moving average of the highs minus the lows, we continue to be positive. And we're still camped out when we look at our 10-day average of the S&P 500 highs minus the lows. We've been up in this level for a number of days. The fact that we came up and have not dropped back down is positive. When we look at the 50-period exponential moving average of the new highs minus the new lows, we're continuing to advance. The black line is the actual indicator. The red line is what we use on the previous chart to give the measurement of the trend. We saw a little bit of a tick down when we compare S&P growth to value. It's still in an uptrend, but it's really been declining more shorter term. The Staples to S&P 500 ratio did tick up just a little bit, but has been declining overall. As this goes down, that often gives good support to the S&P 500. So what's our outlook for Thursday? There will be another policy meeting by the European Central Bank, and also on Friday, the Bank of Japan will be meeting. There's still more influential earnings reports that will be released. The technicals are still positive but overbought. I haven't been able to change that. We're still in that same situation. We will be getting the advanced second quarter GDP. That's a pretty important report, and this is the first time we're going to see the release of second quarter statistics. We'll also get weekly jobless claims as well as durable goods orders and the advanced goods trade deficit, as well as advanced retail and wholesale inventories. Finally, we'll end up getting pending home sales. The GDP is going to be the big one. Keeping an eye on the geopolitical events. Right now, it's all about inflation and interest rates as far as the market is concerned. Here's the updated economic calendar so far for the week. And looking at the Stock Traders Almanac statistics, we're 50-50 for the week after options expiration. We're pretty negative historically for the Dow, S&P, and NASDAQ. We will be on the 18th trading day of the month, where we might see some weakness coming back in as we head into the latter part of July. Seeing that same thing when we look at the NASDAQ as well. So our scenarios, not going with the down one yet because our technicals are still positive, but we are overbought. You don't really want to go against that because so many of the things remain positive. We're not really going with the up one, even though we would default to that because we are overbought, but still there's a positive backdrop behind the market right now. And we're not going with the sideways trend because our ADX, both the short term and the regular ADX, are showing that we're in a solid trending environment. So the warning signs, we're still wondering, is there going to be a convergence of these bearish signals? Some of them have been kind of dropping off now. Some of them we're coming more into, like weak seasonality. The longer-term trend signals may be signaling a top. That's the longer-term chart for the S&P and the NASDAQ 100. We're still dancing right around that resistance level. We're also coming into a seasonally and historically weak time of the month as we end out July. The oscillators, they're still kind of negatively diverging, but actually they're turning much more negative. It's the NASDAQ 100 that we're watching the most right now, and it is looking more negative. The VIX is still showing that there's not a lot of fear. The cumulative new highs and new lows still are showing weakness. The 3-month yield, I didn't show that chart. We're above the level where we were at back in 2007. If that starts to drop, is that going to give us some kind of a signal? S&P 500 growth is weakening even though it's still in an uptrend. And then earnings season will come out on a stock-by-stock basis. Some positive signs. I go over this in the weekly video. Seasonality and setups, those are still in the background and they are positive. The Special K daily chart is positive. The weekly chart is negative, but showing some improvement. The longer-term equity put-call ratio is positive. The S&P is still above the downtrend channel upper line. I don't show that chart because we're still far away from that upper line. We're still in a risk-on posture, even though we've been taking a hit over the last few days. Lower price levels may provide support. Again, this really hasn't been tested all that much, so we're just hoping that lower levels will provide support if we see some more follow-through weakness. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, they're still doing their breakouts, but they're running into pivot level overhead resistance that they have not been able to break through. The Staples to S&P 500 ratio continues to decline. The Russell 2000 as well as the small cap index and the mid caps have generated recent golden crosses. Small and mid cap growth continues to be positive. The Copic curve and the Pring bottom fisher have generated recent buy signals. So our conclusion, the S&P, it's still positive, but we are still overbought as well. In the short term, positive but overbought. Same thing can be said for the intermediate term. Long term, we continue to be positive. Thank you. I hope you found this helpful. Have a great day, and I will talk to you in the next video.